Hello, everyone. Welcome to our discussion of PowerPoint slides having to do with Chapter 3. We're going to start with this one. This part is going to be about things that are included in income, gross income for tax purposes, and the second one will be about things that are specifically excluded. Now, remember, the general rule is everything is included unless specifically excluded in the law, but there are some additional, you might say, rules or hints or things that help us realize when or how to understand what we mean by including income in our taxes. So the idea that things are recognized or put on the tax return is the key thing. So when we use the term recognized in tax law, that means that it is actually put on the tax return somewhere on the 1040. So to have that happen, income must be realized and earned. Okay, so things that are unearned or not earned yet typically are not income. Okay, so we've received something, realized it. However, it doesn't have to be realized in cash. You can receive something other than cash, okay, to be included in gross income. That there has to be an economic benefit. The transaction must have occurred, meaning some payment or some transaction indicated. It can't be that just that your house increased in value. That means there's no transaction has happened. All we've done is we may feel like we are our house is worth more, but that is not. There's not been a transaction. There's no conclusion to the transaction, and there is specific things in the law that are tax exempt income that we will talk about. Okay, so if it's not that and it involves a transaction, some type of a transfer of ownership or some type of payment, then it's included in income. Okay, this most taxpayers, okay, use what's called the cash method of accounting. So when you're an individual, technically, you could choose other ways to determine your income. We learned in earlier accounting classes the idea of accrual accounting, where you record income when it is earned, not necessarily when you receive it. But the IRS allows us, or the tax law allows us to choose what method we use. And when you file your first tax return, you do so using the cash receipts and disbursement method, and therefore it becomes almost automatic. You have to go through quite some rigmarole to change that. So that means that your income is taxable or included on your tax return when you receive it, the cash receipt. So if you work on the 31st of December for your employer, but you don't get paid that until January 2nd, it's income in on January 2nd in the year that, and that's the year that will be reported on your W-2 and you'll put it on your tax return. Now, when you have a business, there can be it can be a little harder to determine that with regard to constructive receipt. Okay, that is someone. Let's say we did some work for a client. They sent us a check. We received the check, constructive receipt, but we decide not to put it in the bank, not to cash it. Okay, not to deposit it until next year. So we got the check on the 30th. We decide to deposit it till the next year. That does not postpone the income. The income is in the year we constructively received it because we were in control of that money. We could have deposited it right then. Okay, so that receipt of property or services, even if it's a cash or a cash basis, okay, cash receipts method, if we receive something other than cash, it's when we receive it. So if someone paid us for our services with a bag of potatoes on the 30th, and we had that and we controlled it, that means we have income. Now, some parts of income, some income categories, you might say, and how they work for the next several slides. Okay, first of all, interest. Typically, you think of interest as being paid by a bank for you to have money in there's a savings account or a CD that's reported on a 1099 INT. You have a specific form. It tells you how much income you received. It's just similar like your employer sends you a W-2. And that is taxable. Almost all interest from banks, savings and loans, credit unions, CDs, all that kind of stuff is taxable. There are a couple of things that are not. First of all, U.S. Savings Bond Series E and EE, okay, they have a little different issue in that they can be reported gradually or fully at maturity. So you have some choices. Not that it's not income, but what you earn it a little bit at a time, but you receive it at the end. So you can, even though you're a cash receipts, you can have it as income each year, or you can wait till the end and report it all at once. And then the definition of tax-exempt interest. The one aspect of interest that is tax-exempt, not included, not recognized. You do report it on the 1040 because we'll see later it has impact on other things, but it is not part of your taxable income, and that is tax-exempt interest. And that is the interest paid by a state when the state of Pennsylvania or other state borrow money from individuals and pay interest on that borrowing. That is tax exempt. U.S. possession like Puerto Rico, the same thing, acts like the state. And any subdivision thereof the state. So cities, counties, school districts. So school district borrows money to build a school, pays interest on that bond, and that is tax exempt when you receive it. You do not have to pay tax on that. It is not included in your AGI. Okay. It is left, but is reported in a special place that's not added into AGI on the 1040. Other types of interest that you might run across when you're looking at preparing somebody's tax return. They may have sold their house or their investment property, and rather than getting all the money, from that sale, the person that buys it asked to pay them over time. And that's what we call a seller finance mortgage. And so you're receiving interest just like a bank would. Okay, and so that's interest income. Same thing with installment sale receivables. Should always be interest on those. Okay, even in situations where there is a loan with no interest or very low interest stated. So, for instance, Uncle Bob gives you a loan at below market interest rate, maybe zero, says, here's a loan. It's a formal loan. There's a note there. Everybody signs it. You treat it like a loan, but there's no interest on that loan. Unless it is small enough to not count, okay, that interest that would have been charged if he were anybody else, okay, is income to him. Okay, so he loans you the money and you don't pay any interest, yet he still will count it as interest income what would have been charged if he were a bank or other lender. Okay, and then some interest, small amounts of interest on bonds sold between interest dates. All interest is reported if it's more than $1,500 on Schedule B. If you have less than $1,500, you can just put it on the line on the 1040. but if it's more than 1,500, you just need to use. You can always use a Schedule B, even if it's less than 1,500, but you must do so if it's over 1,500 to report interest and dividends, as we'll see in the next slides. So the next category of income is dividends. Okay, these are distributions to shareholders out of the profits of the corporation. Okay, so qualified dividends are from the corporation and a domestic corporation. So the thing that comes up when you're preparing tax returns often is when that you have dividends are reported to the individual taxpayer. You have to decide whether they're qualified or not. Okay, if it comes directly from a company and that company is in the United States or some foreign corporations, you can assume it's qualified. And typically the broker statement will tell you if it's qualified or not. If it's from a mutual fund, which is very, very common, okay, then it is not qualified and it is taxed. It doesn't fall under the special rules. So if it's qualified, it falls under special rules. Now, when you prepare tax returns, especially using the Tax Act software, okay, that we're going to use, you'll need to put in the amount of qualified dividends and the amount of regular dividends. Okay, so if all your dividends are qualified, then the amount of dividends, regular dividends, and the amount of qualified dividends are the same. Okay, the amount of regular dividends has to be more than qualified. Okay, all qualified dividends are regular dividends, but not all regular dividends are qualified. So, but you're going to have to put both numbers in. That's how it needs to be reported on the 1040 and in the tax return software. Dividends are included. So difference than tax-exempt interest. We talked about a couple slides ago. Tax-exempt interest is not included in AGI. Dividends, even qualified dividends, are included in AGI. Always included in income, even if they are taxed at a 0% rate. So as we go to the next slide, we find that dividends have a special tax treatment. That does not change that they're included in our income, whether they're qualified or unqualified. This is only for qualified dividends. They have a special set of tax brackets. You'll remember in Chapter 1, we went over the tax brackets, the tax rate schedule, how to calculate the tax based on income and so forth. Very simple tax brackets. If your income is less than $89,250, married filing jointly, head of household 59, separately and single 44, your dividends are taxed at 0%. You're still included in income, but their tax rate is 0%. So the part of your income that is represented by these qualified dividends is the taxes rate is 0. And then the dividend rate or the tax rate is only 15% up to income of 553, 277 almost, 523 or 492, depending on your filing status. Again, another situation where filing status and what qualifies is very important. Okay, all the way up to those very high amounts is only 15%. That's much lower than the regular income tax rate, which goes up to 34%. And only when you get over those amounts do you have a tax rate for dividends, qualified dividends of 20%. Then it's only 20%. And that's the highest it will ever be on qualified dividends. Even if you have millions of dollars of qualified dividends, it will never be more than 20%. So you'll pay 0 on the first part of it. And you'll pay 15%. If all your income was qualified dividends, you pay 0 for the first $89,000, let's say, if you're married filing jointly, then 15% on all the rest up to 553, and then 20% on the amount over that. That's how those tax brackets work. Much lower tax rates on these qualified dividends. So important to know if it's qualified, and important to know what other income is to figure out what the tax rate applies. Okay. Some other things that might come up. Stock dividends and stock splits are generally not taxable. You don't get any cash. You only get more stock. And the tax law has generally treated that. The courts have ruled that that is not income. Like interest, dividends are reported on the Schedule B if they're over $1,500. If they're under, you can just put them directly on the 1040. Now, when you get a tax refund from the state, not from the federal, this is only from the state or local governments. In Pennsylvania, you also pay local income tax that you could possibly get a tax refund for. You get a refund, and they are taxable if in the prior year the amount of tax you paid to the state was deducted as an itemized deduction. If you didn't the year before, then you don't have to worry about income when you receive a refund. Okay, the taxable amount is the lesser of the amount received or the amount deducted on Schedule A. That's where you list your itemized deduction. Now, we haven't learned all the itemized deductions until we get to Chapter 5. When we'll learn all about the itemized deductions. You only use the itemized deductions if they are more than the standard deduction, which we have learned about. And most people, it's not. So most people are not going to have to worry about their refund being taxable. But they will if the amount received, okay, the lesser the amount received, the amount deducted on the schedule, or the amount by which the itemized deductions exceed the standard deduction. So if last year itemized deductions were $30,000 and the standard deduction was $26,000, okay, then you only got a benefit from the taxes. If you itemize your state taxes you paid last year, the only benefit was the extra $4,000, right? Because the itemized only exceeded standard by 26. Everybody gets the standard. So the only benefit you got was for the extra over the standard. So the most you could have a refund, the taxable, would be the $4,000 that you went over. Okay, so you always have to look the previous year, what that standard deduction was, what our itemized deductions were compared to the standard, to know what your maximum amount you could have as income in the current year. So that's a little confusing in that you're going to be preparing 2023's tax return in 2024. You'll be looking all the way back to 2022 to decide whether the refund you received in 2023 is taxable when you're filing your tax return in 2024. All right, Social Security benefits. Another kind of confusing part of, and is included income partially. Okay, so it could be, this section could be in either the part about including or excluding, because never is all of your Social Security benefits taxable. Okay, and it could be as low as zero, depending on your income. Could be as low as zero, and it could be as much as 85%. It will never be more than 85% of your Social Security benefits. If you see a taxpayer with Social Security benefits, then you must go through the process of calculating provisional income to determine how much of the Social Security is included in income as taxable income. And the first thing you do in that process is calculate provisional income and then compare it to the thresholds. So what is provisional income? Well, it means we have to recalculate our AGI. Okay? So we take AGI without the Social Security benefits. And then the one that's probably most common is you're going to have to add your tax-exempt interest back in. Remember, tax-exempt interest is left off of AGI. Now we're going to put it back in. That's why we have to put it on the 1040, even though it's not included in AGI. And we may have other things that have to be added in here, like interest on educational loans, deducted tuition and fees, okay, which is no longer deducted after 2022, so it's not an issue, okay. So most important is that tax-exempt interest, and then the last one, 50% of Social Security benefits. So provisional income is calculated by adding these things onto our AGI. So if we have interest income and then we have tax-exempt interest, we're going to add those together to get provisional income. Our AGI will only include the taxable interest, not the non-taxable interest. But this one does include the non-taxable interest. 50% of Social Security benefits, okay? And then we're going, if we exceed the threshold by the first threshold, there's always two thresholds depending on this filing status, then 50% of the Social Security benefits are taxable, okay? And that can be as much after the second threshold as 85%, okay? So what are those thresholds? Okay, there's really, it's pretty easy. First of all, they don't change with inflation. There's one part of the law that probably should be, but it is not, index for inflation. The law has never gone back and changed these amounts. These amounts have been the same for probably 15, 20 years and not been increased with inflation at all. So lots of things in the tax law change automatically with inflation. These do not. So focus on married filing jointly. If your income, your provisional income that we just talked about calculating is below $32,000, no Social Security is included in your income. Okay? If it's between 32 and 44, then it is either 50% of the amount over the 32 or 50% of your Social Security. If your income is over 44, provisional income, okay, it could be as much as 85%. All right? But again, you're going to have to make a calculation. You see that if you're single head of household or qualified widower, the lower limit is 25 and the upper limit is 34. A little different, a little lower. Okay? But they work the same way. So you might say there's a 0 threshold. In between 32 and 44, there's a 50%, and then over 44 is at 85% or a mix. Okay, so let's look at an example. Okay. Karen receives a return, files return as a qualifying widow. She receives $7,000 of Social Security benefits, $19,000 of interest income, and $5,000 of non-taxable municipal interest. Okay? So her provisional income, okay, would be the $19,000 of interest income, the $5,000 of non-taxable municipal bond interest, and half of her Social Security benefits. So that's $27,500. 19 plus 5 plus 3,500. So Karen will report the taxable Social Security benefits equal to the lesser of 50% of Social Security benefits. That's half of the 7,000, 3,500. That's the most she could be. Or 50% of the excess of the provisional income over the lesser of those two, right? She's only over the provisional income threshold of $25,000 by 2,500. So half of that is 12,500. So she either includes in her AGI 3,500 or 1,250, whichever is lowest. Okay. So for most of the time, it'll be the lower of the two. It will be the amount over the threshold. Okay. Now, when you get to the second threshold, then you have a situation where it's lesser of 85% okay, or half of the in-between amount plus 85% of the amount over the threshold. And the formula is in your textbook, okay? You'll want to apply that carefully when you work on your homework. Some other things that can be taxable, sometimes it might be forgotten or missed, okay, should be included in AGI. Jury duty pay, usually not enough to make a whole lot of difference, but sometimes that can be significant if you were on the jury for a while. Prizes and awards. You enter a contest. You do a writing contest, and you win. That prize is included in income. Okay? Forgiveness of debt. Your credit card company decides to forgive your debt because you've written a letter telling them how broke you are, things like that. Okay? Most of the time, that forgiveness of debt is included in your AGI. A very kind of an odd outcome when you just, it's not like you got any money, it's just that you don't have to pay something. That benefit is considered income. And then if you had a problem, say for instance your car got totaled, okay, and you actually received from the insurance company more than you paid for that car, or maybe whatever other asset it was, then the difference could be income. Okay, if it truly happens, it's kind of hard to see that would happen very often, but just in case, that is included income. So part 2, we'll get into exclusion specifically in the tax law.